Kyle, 2017's in the books. Many blessings for all of us as it relates to the markets and portfolio returns. Just a fantastic year. I've been doing this a long time. I'm rarely surprised by anything, so I don't want to say I was surprised by last year, but I think if we went back to the beginning of last year and had made some predictions, very few of us would have had these kind of expectations.
Yeah, Brian, extraordinary returns in stocks and bonds and stocks outside the U.S. Really anywhere you look, the returns were compelling and in many ways, again, extraordinary, but I think there's a lot to it more than just, great returns for investors.
For all the things there are to worry about, and there always are, people keep asking, well, why did we do so well last year? And the story is pretty simple, I think. Corporate earnings rose, give or take, 11%. And the global economy is kind of kicked in, right? So you have growing earnings on a background of a solid economy throughout the world. It's no wonder that stocks performed well.
Yeah, Brian, and as we look at that growth, really, it could be much of the rest of the world that's growing faster than the U.S. as we look ahead. And so that provides some opportunity for investors outside the U.S., opportunity that we've just started now to recognize. A big part of returns outside the U.S. this year were just currency, that the dollar weakened a little bit and U.S. investors benefited from that. But as we look ahead, it's that mismatch between economic growth here in the U.S. and much of the rest of the world that's probably going to provide some opportunity for the long run for those investors.
Yeah, so it's built on real fundamental data and it's built on strength. Now, the flip side of that is things to be a little bit concerned about. If domestic stocks were up 20% or more, now maybe half of that came from earnings, the other half came from what we call expansion of multiples, which means people are paying more for those earnings. We need to be a little bit careful about valuations as we're paying more and more for each dollar of earnings. Price to earnings ratio is now in the 18s. Without bargains and with expensive stocks, your downside risk gets a little more important to pay attention to.
Yeah, and less of an issue as long as interest rates remain low. And certainly as long as inflation isn't an issue, interest rates stay low. But I think if we see inflation come back finally after a decade plus of really being absent from the market in any meaningful way, and then you have interest rates respond to the expectation for inflation, now all of a sudden the pricing of stocks looks less favorable when you're talking about paying a little bit more than fair value for stocks.
You think about last year and you boil it all down to earnings and low interest rates. It's a no wonder stocks perform well, but maybe a bigger surprise was the bond market and how it held up. If you go back to the beginning of the year, most expectations were in a rising rate environment, perhaps on a strong dollar, that bonds would weaken, and it wasn't the case.
Yeah, a great year for bonds. And as we talk about kind of the academic side of investing and think about that efficient frontier and looking at what the appropriate mix or the appropriate balance is for investors, historically, we had always said that maybe 60-40 or 50-50, right in between there was the right place to be for investors. And I think the challenge is, as stock returns have been so much higher recently, and as the volatility for stocks has been so much lower, it's starting to shift the academic thinking a little bit more towards overweighting stocks. But investors have to remember that is now discounting a big chunk of volatility that really should be there that wasn't last year.
People ask me all the time, what's next year going to look like? I'm kind of interested in curbing everybody's enthusiasm a little bit about the opportunities to make another 20% in stocks. And yet, it doesn't mean that it has to be a bad year. It could be a year where it's kind of neutral, where things peak a little bit, where we crawl along instead of walk briskly.
Brian, I think my concern is that we've become complacent with volatility in the markets. And, certainly there's every expectation that things can continue on the path they're on, maybe not quite as vigorously as they have, but certainly, the economic outlook is favorable, the outlook for corporate earnings is favorable, and that tends to set up quite well for stock returns. However, when you look at the lack of volatility in the last year, that's not going to continue. And so even if 2018 turns out to be a great year, you have the concern that there could be a correction at some point in time. You have the concern that there could be something unanticipated that causes stocks to fall a little bit. And if investors aren't used to that, and if they respond to that volatility, they may be doing the wrong thing simply because they just haven't been used to a market correction or any kind of market reaction.
So I think maybe for me, if the opportunity set isn't as great as it's been in the past, then perhaps my risk shouldn't be as great as it's been in the past. Not because I'm scared or not because I need to be worried, but just because there aren't as many upside opportunities, perhaps.
The point about making sure you get balance right is the most appropriate piece. It's not about trying to time when that correction is going to come. We know you can't do that. It's not about trying to figure out exactly how much it's going to fall and when the right time to get back in is. It's really about making sure that you're appropriately positioned for whatever might happen.
So Kyle, I like to think of it this way: match your risk to the opportunities that are presented.